Bear market explained. Important. What is a bear market? There is a reason the emblem of Wall Street is a bronze bull. Investors usually classify their sentiments as bearish or bullish. These words come from the animals bear and bull respectively. A rising market is called a bull market, and a falling market is called a bear market. When people in general think the market is going to go up, we say bullish. This explains the bull statue, because a rising stock market is a sign of growing profits, and profits are the whole point of capitalism. If you're a nerd wondering who was the genius who came up with these terms, today is your lucky day. It is believed that a bear attacks its prey by swiping its paws downward. This causes the prey to fall. A bull attacks and lifts its prey in the air by using its horns, hence the name. We don't know how accurate this is, but this is the only theory we have. You can cross that off your list. Technically, when a market falls more than 20% from its recent highs, it is officially a bear market. It is usually associated with a fall in an index or a group of stocks. The S&P 500, which is an aggregate of the top 500 stocks listed in the USA, dipped 24% in June 2022. So technically, we did go into a bear market just now. But the 20% is just an arbitrary number that came out of a magic 8-ball. It depends on individual investors, their risk appetite, and the type of asset. 20% fall is common in volatile assets and seasonal businesses, but not preferred in stable assets like Johnson & Johnson stock. The steel industry goes through a cycle of ups and downs every 7 to 10 years. It would be wrong to say steel companies are in a bear market by solely relying on the 20% fall rationale. What causes a bear market? A stock price is just what a person is willing to pay for the stock. Investors use complex formulas and valuation models to come up with the value of a stock. This value is based on the future expected return from holding the stock. In simple words, if a stock will give you a good return in the future, that stock will be priced higher than a stock that is going to give you a lower return. So when these investors realize that the future expected cash flows are lower than initial budgets, the prices fall. When do the future expected cash flows fall? It's usually due to wars, economic slowdowns, pandemics, bubble bursts, tax policies, regime change, and other political reasons. An example would be discounting future dividends to their present value today. If a company gives $1 in dividends every year, some investors might be willing to pay $10 for that stock. That's a 10% annual return on money invested. There's also a chance that the stock might go up. Imagine due to pandemic lockdowns, the company is unable to reach its customers. The dividends fall to 40 cents per year, and the stock price will also fall to match the fall in income. It might start trading near $4. Welcome to the bear market. How long do bear markets last? You never know when the bear market starts, how far down it will go, and how long it will take to get there. You won't be the first person who thinks they've figured out the market, and you also won't be the last. In 2008, the market crashed 65% over 2 years, while the 2002 dot-com crash lasted 3 years as markets fell 50%. During the pandemic-induced 2020 bear market, the index fell by 35% in a month and recovered within 6 months. In July 2022, it took 6 months to fall by 24%, and we have already recovered 50% of the fall within a month. These are just raw numbers and might not have any correlation. It is easy to look at patterns and expect you have figured out the right answer in hindsight, but it never works in real time. Millions have tried and failed. Various authors, traders, and 16-year-old crypto bros have tried to come up with their theories of how to find the next low in the market. But you can come to just as equally a consistent answer if you just toss a coin or ask a monkey. So far, the 2002 dot-com crash was the longest sustained bear market after the Great Depression. The 2020 pandemic-induced bear market was one of the shortest ones and only lasted a month. One thing is for sure, bear markets will always come to an end someday. It could last from a month to 3 years, but eventually the stocks will go back up. How do you make money from the bear market? It's pretty easy to make money from a bear market if you follow 2 basic rules. Number 1, you must not try to time the market, and number 2, you must not try to predict the bottom. You can use short selling, futures, options, and inverse ETFs to profit heavily from bear trends. It begs the question, which stock do you short? The answer is that it depends on the reason for bear markets. Some stocks and industries perform weaker in a bear market. During the pandemic crash, travel, tourism, airlines, hotels, and multiplex companies performed exceptionally bad. These were hit harder than the others. Shorting them using futures, buying puts, selling calls, or simply buying their inverse ETF with margin would have made you bank. An example would be Marriott International. The S&P 500 index came down only 35% during the 2020 bear market, but Marriott fell 70% and has since recovered completely. Turns out that when people can't travel due to quarantine, hotels lose their customers. Using this advanced knowledge, one could have deduced that hotels and airlines are a good shorting opportunity. The 2008 market crash was due to banks giving loans to people without checking their ability to pay them back. So when people couldn't pay them back, banks lost a lot of money. The best way to make money from this would be to short the banking index or short the bad stocks individually. The latter requires you to have the ability to read balance sheets. Lehman Brothers got all the attention, but they were not the only ones that closed shop. Morgan Stanley was one day away from filing for bankruptcy. The current bear market is due to the tensions in Europe and Asia. If there is an all-out war, defense companies like Lockheed Martin and pharma companies like Pfizer will experience a windfall of profits. These are some good bets you can have in your portfolio in times of war. Practices to keep your net worth safe during a bear market. Here's the thing, you will invest in stocks. Someday the stock market will go into a bear market, could be 10 years later, or it could be tomorrow. If you already own a stock that is going down, you must evaluate whether or not you should sell the stock or not. The answer is usually a no. Judge whether the bear market is a one-time thing or whether the damage will be permanent. When you buy Marriott or Boeing, you know that they will climb back up once the restrictions are lifted. In such cases, you should be buying these stocks as the prices keep falling. You should think that these companies are just going on a discount. The lower they go, the more you buy. This brings your average purchase costs lower. It's called dollar cost averaging and is practiced by everyone. If you think that this is kingdom come and the company will go bankrupt sooner or later, then you can consider cutting your losses and selling the stock. This happens very rarely. Usually all companies can survive by taking loans and bailouts. Another good practice is not putting all your eggs in one basket. If you're investing your savings and salary, you are doing it so they can grow safely. You would prefer safety over a higher return. You should try and diversify your portfolio into different asset classes, different industries, or even different countries. A portfolio consisting of German engineering companies Siemens, Americans McDonald's, Swiss bank Credit Suisse, Indian Railways, and Saudi oil giant Aramco is an example of a safe, diversified investment vehicle that will outlast most bear markets. As per the famous book The Intelligent Investor by Benjamin Graham, when times get tough, one should start holding more bonds and gold instead of stock. When times are good, stocks will be a better investment. 40% stocks and 60% bonds are a good mix during bear markets, while 60-80 stocks and 20-40 bonds are an ideal ratio for bull markets. Time to sum it up. Invest in sectors that are likely to profit from a bear market. Short companies that are likely to perform exceptionally bad in the market. Diversify your holdings into various industries and asset classes. Don't try and predict the bottom. Do not panic sell, and rather accumulate good companies at a lower price. What are your thoughts on bear markets? Let us know in the comments below. If you have any questions, do not hesitate to ask them and I will get back to you. Thanks for watching here on Tom's Do-It-Yourself Investing channel. If you haven't subscribed yet, make sure to subscribe and hit the bell icon. If you found this video helpful, give it a thumbs up, and don't forget to share the knowledge with those who might find it useful. I will be back with more videos. Until then, take care and stay tuned.